Your chances of becoming a profitable trader shoot up drastically if you're not only able to learn these 5 concepts, but combine them as well. I'm gonna teach you a framework to put them together so when you get into a trade, your win rate will be way higher than what it is right now. You will lose money trying to trade if you just learn a couple of these concepts, but don't learn how to use them together. I've been trading for over 7 years, and these simple seeming concepts are more complicated than a lot of people make them out to be. I'm gonna share with you the reality of what it's like using them versus the theoretical ideas of how they're supposed to work. Now let's start off with a more advanced concept that I've discovered myself from watching and reading the markets for years. Think of the market like a rubber band. A rubber band always has a point of equilibrium. As you stretch the rubber band, it takes more and more momentum to keep going in that direction. Secondly, as you stretch a rubber band, it wants to snap back to that equilibrium. And the more you stretch it, the more it snaps back. The market works exactly like this. Check out these charts right here. The market moves fast in one direction, and once it loses that momentum, it snaps back. Now, of course, like anything in the market, this doesn't always happen. Sometimes the market will have a big move up, and instead of snapping back, it will sit there for a while going sideways. But the same concept applies if you ask me. The market is still refinding that equilibrium, and sometimes after that sideways move, it will start a new trend, potentially reversing. A healthy trend in the market is when the rubber band expands and contracts. If a trend is going to keep going, you want to see pullbacks in. This trend right here is a great example. There are healthy pullbacks as the market slowly moves lower, and then all of a sudden it starts to drastically change its momentum to the downside, and it gets overextended. And so the rubber band has to snap back to that equilibrium, and the trend shifts. So how can you actually use this in your trading? Well, some of it just adds to your database of how the market works and reading the market exactly like that example. But what I've done with this is when I see the market expand, I'll keep my eye out for the potential of it snapping back to equilibrium. This can work really well for reversal trades, and I'll show you how I combine it with a bonus indicator that I have only just recently discovered. But let's first talk about the 2 most impactful market patterns that I've used the most in my trading and what I've realized about them over the years. Here's a trade I took a while back. The market is selling off really nicely, and then it starts to lose momentum and go sideways. This can signal 2 things: either a pause in the trend while it regains some strength and it waits to continue to the downside, or a loss of momentum that will break its downtrend and it could reverse. This is what I like to call a flag pattern. The market has this downtrend that's pretty clear, and then it's gone into some sideways action, consolidating. And so what I look for is a break of that flag pattern to potentially look for a reversal. You can actually see a great example back here where the market had a really nice uptrend, and then you can see it goes into a consolidation, and it's actually at a resistance level that I previously drew. And so this combined with that gives a good reason to say, okay, when it breaks this flag, well, I think that it's going to reverse because it's lost that momentum. And so that's kind of exactly what I'm looking for right here. Is we have this flag pattern, and it's at a previously support level that I've found, and then once it starts to break that and show some strength, because that's what I want to look for when the market is going to get going here. And so I will enter in on a trade and look for the market to reverse higher. And then once I'm in that, I will just manage the trade and capture the swing as the market bounces off of that pattern, as well as using a couple of other factors. The key that I've realized over the years with this pattern is just because the idea of the pattern is that it will either continue the trend down or reverse like it's done here, doesn't mean it will do that. There aren't just 2 options that the market will take. It can do any number of things. Just because it starts to reverse here doesn't mean it will go super high and reverse all the way back to the other side of this range. It could just go sideways for a long period of time, and that is a really big factor with anything when it comes to the market, is understanding that there are other things that can happen. Just because it looks like it could reverse doesn't mean it will make a massive reversal in your favor. You have to be ready for the market to do what you don't want it to do. Now, my favorite market pattern involves a lot of that actually in the next concept we're going to go over, but this is a purely reversal pattern, and I use it in almost every trade I take. It can work for predicting that the market will go up or down, but what I've found in my trading is that it's more successful at predicting that the market is going to reverse down. It works by reading these swings in the market. The theory of how you spot this pattern, if you're looking for the market to reverse back lower, is you look at the highs of the swings that the market made. And so in an uptrend, as they get higher and higher, you're looking for that to shift. And so currently this is showing an uptrend. And then what you look for to confirm this pattern is that a swing starts to make a lower high. And so that is how a head and shoulders pattern works. The idea is here's the head and here's the shoulders of that pattern. And then what you also have is called the neckline, is sometimes these swings right here will be in the same area, but it is not a key to the pattern that we'll get to in a second. And so what the reality of this pattern looks like is a little harder to decipher. But again, what you're looking for is you're just looking at the swings in the market to make clear ups and downs. And so big key things about this pattern that you want to be looking for is you want that major swing that shows the top of the pattern, that's the head in the head and shoulders. You want that to have a clear rejection. If you look at, we have a strong move up here. There's a little bit of a swing here. That's our first shoulder. And then the market keeps going up in its normal trend. But then this move right here, if you look at these 4 or 5 bars here, really 3 bars, it's a lot larger than if you look at this little pullback right here, right? The market is clearly making a shift. You can see actually the low of this swing, and really down here, the swing goes all the way down here. It's definitely lower than this swing right here. And so what that shows is the market's starting to make new lows, as well as it shows a lot of weakness. And then we have our same thing on the flip side, that right side shoulder here, the swing low that we have is really, it's lower than this, which is the key for the pattern. But if you actually look at this also, it's lower than this one right here. Sometimes these will match, and that kind of shows, indecision. But if this one is lower than this one, that shows even more weakness, that the market tried to keep going higher and it cannot make that much of a move higher. It's already lost all that momentum. Sellers are coming in and they're wanting to push this back lower. Now, these are the key important factors to look at with this pattern, and they also work for the bullish version. It's the exact same. You're pretty much just looking for the market to make swings, and all the main difference is you're just looking at the lows. And so the same thing on the flip side is you're looking at the lows. Again, you want this move right here to be a stronger move, and the same thing on the bullish side. As you can see, this swing right here, it pushes higher than this one right here. And so again, that shows strength. Now we're looking for strength in the market. And so some unimportant factors to look out for. A big one is this neckline right here, is you do not need it to be like in the example up here where it's flat. It's okay to have it sideways or diagonal like this. And kind of like what we talked about, that actually shows some strength. And then another thing is, as well, is you don't need the main swing to be that much lower. You do want it to be lower, but it doesn't need to be like this example right here where it's clearly a lot higher or lower in our bullish version. And so those are some important things to look out for. And so if you want to get access to this sheet that I've made, just check the link in the description below. I go over a lot more patterns in it and things to look out for, unimportant keys to the pattern. And so it's a really helpful tool that I would definitely go and check out. Now, last thing with this pattern, just because you see it show up does not guarantee that the market is going to make a massive reversal. That's why you always want to combine it with the next concept. The craziest thing about trading is people are always trying to look for that indicator that will tell them when to take a trade. So it's super simple and easy, when in reality, that will never exist. In my experience, the closest thing to that is actually using market structure to get a good idea of what the market might do. Trend lines are a super simple way to do this. You have clear swings in the market that you can draw a trend line off of, like a downwards or upwards trend line. And then once the market comes and hits that multiple times, you can bet that the market is either going to go down off of it, or for an upwards trend, you can bet the market is going to go up off of it. These can be very consistent if done properly. Now, just like all of these, I'll show you how to combine them with a checklist in a minute. Now, support and resistance levels are drawn from your basic swings too. These always seem kind of like a duh concept, and I know how to do that, but over the years I've realized there's a few keys about them I didn't learn right away. One is treating them like a zone. The market doesn't have to come down exactly to that low that is made, or if it breaks the extreme low slightly, it's fine as well. Because it's all about the idea that there is just support down here and the market could bounce off of. Remember to treat everything in trading with a statistical mindset. Nothing in trading is certain, but you can make the odds more in your favor. What I've realized over the years is patterns can have a domino effect. Patterns like the head and shoulders or market structure are the larger dominoes, and candlestick patterns are the smaller dominoes. If you learn how to use and combine them, you can start to have a domino effect of spotting a smaller reversal and have it cascade into a larger one. Candlestick patterns are like a cheat sheet of what is happening in the market. Reversal patterns like this engulfing candlestick pattern are reversals because what this shows is over these 4 candlesticks is the market was going up in a nice trend, and then all of a sudden there was a massive switch in momentum shifting the market lower. And so again, if you use this with other things like a head and shoulders pattern that we have here, and then as well combine it with something like a resistance zone, you can trigger those larger reversals and cascade things into another. Now let's talk about actual indicators real quick. Indicators can be a massive trap to new traders. I don't use indicators myself because over time I've found that just learning to read the candlesticks like this has worked for me. Some people may find indicators work really well for them, but the biggest importance with them though is to not use many and keep it simple. Any strategy should be simple. You can totally combine an indicator with some of these patterns and that could work out for you. Some of my students like to add volume to their entry checklist as it helps them confirm that the move is real. The biggest thing to remember with indicators is there's never going to be one that will tell you when to profitably buy and sell consistently over the long run. That will never exist no matter what anyone tells you. So if they do, run away. Now let's get into another advanced concept. I mainly focused on trading the S&P 500 index. I've watched this market for years and almost every day I found out something that has made a big impact on how I approach trading. So take a look at these charts. All of them have good momentum moves happening. Some of them are reversals, but some of them are just breakouts from continuation or chop. So what do they have in common? Here is 7 a.m. on all of them, which is Pacific Standard Time as I'm on the West Coast. So this would be 10 a.m. normal East Coast market time. But at around 7 a.m. or 30 minutes after the SPY opens, the market likes to make a move. Now take this time as a rough idea. You can sometimes see this move happen a little bit before 7 or after 7. Now let me show you how I combine everything I've shown you in this video to create a trading strategy. You don't need to learn any other trading concepts to make a profitable trading strategy. And so let me walk you through the checklist now, combining all of these things. Now the first thing in that checklist is finding a support or resistance level to trade off of. In this example, we're using a support level. We're looking at a 1-minute chart of the S&P 500 futures, and the support level I've drawn off of just a couple of big swings on an actual 15-minute chart. And then I zoom in to a 1-minute chart like we have here and look for a more accurate entry using the things that we have talked about. And then the second thing is making sure this downtrend here is broken, because you don't want to go against the trend, right? The trend is your friend is a really classical trading saying. And that's exactly what I'm trying to do here is I'm waiting for this downtrend to break, because if you don't wait for that to break, it could just continue going down and you would just end up with a losing trade. Now the 7 a.m. timing that we've talked about is right here, and it already kind of had that bounce there. And so that's not happening here. But what you have to remember is you don't need all of these to happen. Again, when you're making your strategy, if you have 15 things you're looking for and you have to have all 15 of those things, you're never going to get into a trade. You definitely have to have a bare minimum to get into a trade, but don't try and be a perfectionist. You've got to just let things play out as they come. And so the next thing is with the checklist is looking for that catalyst of the rubber band move. And so we've kind of already had a rubber band move right here. The market had a clear push higher and then it snapped back to equilibrium there. But look at the larger down move here. This is kind of a potential snapback that I'm looking for as a larger reversal. And then the next thing in the checklist is, again, just looking at that head and shoulders pattern, right? We kind of have a downwards trend with the swings, and then we have a higher swing here. And so this is kind of a crazy looking head and shoulders pattern. They don't typically show up like this, but you can see we had a very strong move off those lows. The market kind of came back to retest again. And so I'm thinking that, okay, this looks like it's pretty good. It's with these kind of candlesticks here, it breaks this kind of mini downtrend. And so again, using kind of that domino effect, cascading effect, expecting that this breaking that smaller trend will kind of move into breaking this larger trend right here. And so that's exactly where I get in. I get in after this little candlestick does a little pullback right here, because, well, if this trend was going to keep continuing down, this would keep continuing down right here, but instead it reverses on it, making this nice big bullish candlestick. And so I like to jump in based on that, assuming that, okay, maybe now we'll start an uptrend here and I can capture that move. And so a key with this specific situation here is you can see we have a almost like a micro resistance level up here. The market did have a strong sell-off from up here, and so you could expect it to potentially reverse off of there again. So how I'm managing this trade once I got in is expecting that to have potential to happen. You know, of course, I'd love it if it shot all the way up here, because that would be an insane trade, but I'm closely watching this thing to break this uptrend that it's currently showing. You know, we kind of bounced here multiple times. And so the idea is if it comes up here, bounces off of that, and then breaks this downtrend, I want to get out of the trade, because the easy move is over, the easy money is made. And when that happens, you know, the market could easily sell back down to here and go into some kind of smaller sideways range. And I don't want to mess with that, right? And so when you're trading, it's best to get in and get out really quickly. And that's really what happens. Just to kind of zoom forward to play it out, it kind of breaks that. I shift the trend line a little bit because, you know, new information, but again, it still eventually does that. The biggest factor that will make or break your trading is knowing how to actually properly draw these support or resistance levels. I initially thought I knew how to, but over the years, I discovered how to tell the good levels from the bad levels. This video right here reveals everything I know about how to find and draw the correct support and resistance levels.